So good afternoon. So till last class we discussed on the international financial management and the MNCs, multinational company, as well as we discussed on balance of payment, the components, as well as the disequilibrium in balance of payment. So today we'll be discussing on international financial environment and the components of international financial environment and so on. So to begin with, the international financial environment. Since we're doing the cross-border transaction, that is, we're doing the business internationally. So we'll come across the environment means the conditions in different countries. So when you want to do any kind of business, so cross-border, that means the out of the boundaries of a country, of a respective country, then you need to deal with some conditions, some elements that happens in some other countries. So this is nothing but the international financial environment, which is nothing but the conditions for activity in economy or in the financial market around the world. It is around the world means not in India. If you're doing business with the US, then the conditions of US also matters in the environment, international environment. And it deals with the credit worthiness of country debts, or with the governments, or with the corporations, or the investors around the world. These are all the components. If you take example, the international financial environment consists of the governments, the corporations, the country debt, the investors, the foreign markets. These are all the components of foreign exchange environment or foreign financial environment. So there are various components of international financial environment. There are four components. One is the foreign exchange market, international monetary system, international financial markets, and last one is balance of payment. This balance of payment is already discussed in the so far classes. So we'll discuss what is foreign exchange market, which is very much important in the today's world. So foreign exchange market, which is the first component of international financial environment. So the foreign exchange market is a over-the-counter market, or we call it as OTC marketplace that determines the exchange rate for global currencies. So foreign exchange market is said to be over-the-counter market. So why it is said as over-the-counter market is because there is no physical building or physical existence of a building or the place where to carry out this foreign exchange market. There is no physical area or physical place to carry out this market. This market is carried out through the internet. So everything happens online. There is no physical building or physical place or physical area to carry out foreign exchange market. So that is why it is called as over the counter market. Next, foreign exchange market is the world largest financial market that decides the exchange rate of currencies. So when the foreign exchange is nothing but, or a foreign exchange market is nothing but, or a foreign exchange is nothing but, when one country currency is converted into another country currencies, it is known as foreign exchange market. Conversion of one country currency into another country currency. I gave an example of if you're doing business with the US government or the US people, or the importing or exporting, then you need to pay as per US dollars. If US is importing from our country, they need to pay as per Indian rupee, vice versa. Done. If you're doing with Russia, you need to do in a euro currency. If you're doing with China, they need to do it in currency, yuan currency. So that is how for each and every country will have their respective currencies. If you're dealing with the respective countries, then you need to pay or receive as per the denomination of respective countries. So that is where, so directly you can't go and pay as per the Indian rupee for US country. Then you need to go for the foreign exchange market. Then you need to exchange Indian rupee to for Indian rupee to the US dollars. Then you can make a payment if you're doing an import or export, whatever it is. So you can see it is also called as forex market or currency market. It is where different types of currencies are traded. So each and every currencies of respective countries are traded in foreign exchange market. It comprises many markets. They trade between individual currencies to provide international liquidity. International liquidity is nothing but you can pay or receive in any denomination of various countries. and it is not restricted to only US, or it is not restricted to only Euro or Great Britain pound. It is it is the international liquidity. You can pay or you can convert any country currency as per the denomination. Different types of foreign exchange are the spot market, swap market, forward market, option market, future, and participants. So this is the structure of the foreign exchange market. So you can see in this example, so for 1 US dollar it is 82 rupees, or now it is 85 or 86. So for the Britain pound, for 1 Britain pound 102 rupees. And you can see in the left hand side 0.012089, that is for 1 rupee the cost of US dollar is 0.012089. The same way for 1 US dollar it is 82.72720,574. You can see the second one, for 1 euro it is 88 rupees 68 paisa. The same way for 1 rupee the cost is 0.011253. The same way for the British pound, for 1 pound the cost of Indian rupee is 102.112168. The cost of 1 rupee is 0.009793. When compared to all these currencies, India is in a negative thing, because there are the standards currencies like US or the euro or the Britain pound or Australian dollar or the Singapore dollar. This is how the exchange rate is given. Next, we have international monetary system. So international monetary system is nothing but it's a set of internationally agreed rules and regulations, or we call it as the conventions. It is a set of rules and regulations or the convention or the policies framed to do the transaction. Which kind of transaction? Cross-border transaction. So when you want to make investment in some other countries, there are various set of rules and regulations you should follow to do the transaction. The same international monetary system refers to system prevailing in world foreign exchange market through which international trade and capital movement are financed and exchange rate are determined. So the international monetary system, which consists of set of rules and regulations, including how a foreign exchange market should do, or how a international trade should happen, or a capital movement has to be done between the countries. That is how the international monetary system behaves. So the important question is, so evolution of international monetary system, how this international monetary system has evolved over the period of time. So to begin with, this started during the time of the era of bimetallism. Since if you see this slide here, the era of bimetallism is not mentioned. Has it here, it starts from classic gold standards, that is 1914 before. But before the classic gold standard, the era of bimetallism started in 1870s. So here it starts from the era of bimetallism, then the classical gold standards, then the interwar years, Bretton Woods system floating, as well as European monetary system and union. This should go from top to bottom, but I had given the era of bimetallism in a separate slide, so that the many of the books you can find these five types. But so this is the era of bimetallism, is a starting or a first phase. So era of bimetallism. So bimetallism itself represents there are bimetals or two metals involved in framing the international monetary system. Here, before 1870, the international monetary system consists of bimetallism, where gold and silver coins were used as international modes of payments. Here, if you want to make any kind of payment internationally or to the cross border transaction, then you have to make the payment as per silver and gold denominations. It was determined, the rate of currency is determined, the exchange rate is determined by gold and silver. So that is why it is called as bimetallism. Two metal, one is gold, one is silver. So during the time of 1870 it was followed, but later on, so after the era of bimetallism, it started with the classical gold standard. So you can see here the classical gold standard, that is nothing but gold was considered as an exchange medium. It was not now, it was from 3000 BC that the rule has come. The rule of the game were simple. It is very simple that each country set the rate which currency unit could be converted into weight of gold. So here the currency was determined by the weight of gold, and the currency exchange rate were in effect of fixed. Why it is called as fixed? It is called as fixed because, so whatever the weight of gold is constant, then obviously there is a fixed exchange rate. Take for example, usually it used to measure in the, you can see in the example, you can US dollar pegged to gold at dollar 20.67 per ounce. Ounce is nothing but 1 ounce equals, it was almost 31.1035 grams. For that much of, for 31.1035 grams, it was around $20.67. This is how the exchange rate has to be done. Here in the second you can see per ounce the cost is 4.2471. On base of weight of gold, the exchange rate was determined, and that was in effect until outbreak of World War One, as the free movement of gold was interrupted. So till it was pre 1914, but when the World War started, you can see here the interwar years. Since the World War One has begun or one has started, there the movement of gold was interrupted. So before the World War One, the gold you can transport to gold to some other, or you can export or import gold to some other countries. But so after, during the time of World War One, the transportation of gold or movement of gold was stopped. So when it was stopped, it was an era where you can't move the gold from one place to another place. So there was lot of fluctuation happened in the currency values, because because you can't move the gold from one country to another country. The US adopted a modified gold standard in 1931. So during the World War One, and it was chaotic aftermath, the US dollars were only major trading currencies that continue to be convertible. So once, as I said, so after the break of World War One, the movement of gold was interrupted as well as, and you can't convert some other currency as per the gold standard, but was only one currency which you can convert was the dollar. So after the World War One, then we started the Bretton Woods. So that is during the World War Second. So Wood was nothing but, after the World War One drew to close, the Allied powers met at Bretton Woods. So Allied powers are nothing but, it was the US or the UK as well as Russia. So these are the countries that are Allied powers that met at the Bretton Woods, the New Hemisphere, to create a post-war international monetary system. So it is nothing but after the World War Second, that was during the 1939 to 1944. So after this war, the many collapse has been done. But now they, what they thought was, the Allied power met at the Bretton Woods. They started, and they made an agreement to establish two important components, or two important institutions, we call it as two important institutions at the time of the Bretton Woods conference. We call it as Bretton Woods twins. So Bretton Woods twins are nothing but, so after the meeting that was held on 1945, two important institutions were started. That is one, IMF, as well as the World Bank. IMF is nothing but International Monetary Fund. The World Bank is nothing but, so IDBI, or International Development Bank for Reconstruction. So that is the two institutions that started during 1945. So because of that, we call it as Bretton Woods twins, because it was in the Bretton Woods conference. I can see the role of IBRD as well as IMF. So IBRD is nothing but International Bank for Reconstruction and Development. IMF is nothing but International Monetary Fund. So IBRD was established to give the loans for the reconstruction of infrastructure, because, as I said, during the period of war, there many construction was, or many infrastructure was collapsed. So because of to regain the economic growth or to start the businesses or the operations, infrastructure was very much important. And which countries who has faced this collapsation, the IBRD started to give the loans for those companies, sorry, countries, and they started recapping the economy or to build a nation. So likewise, IMF was also one of the part or one institution which used to give the loans for the countries where the balance of payment was fluctuating. There is nothing but to monitor the exchange rate stability or to advise the fixed exchange rate system and to give the loans for the countries to overcome balance of payment problems. So balance of payment problem is nothing but if the country is facing negative impact, then obviously the IMF is to give the loans for those countries to regain or to pay the balance of payments and to have a stability in the things. Next, so after the Bretton Woods, the fourth one is the floating exchange rates. The floating exchange rate is nothing but since the March 1973, the exchange rates have become the much more volatile, because after that the Britain also the exchange rate would have fluctuated so much because so, as I said, from the era of bimetallism, the currency were fixed. Even in the time of the interwar periods or during the time of Bretton Woods and till the period of 1973, the exchange rate was fixed, which was very difficult for other countries to the face the things or to the fix the currency rates. So after that, the floating exchange rate has been started from 1973, whereas where you can observe the 1976 the Jamaica agreement, where they decided to have the floating exchange rate. So floating exchange rate was very much useful because the IMF met in Jamaica to agree the new set of rules and regulations for the international monetary system. The key elements also after the Jamaica agreement was the flexible exchange rates were declared accepted to the IMF members, and the central banks were allowed to intervene in the exchange markets to iron but unwarranted volatility. So unwarranted volatility is nothing but, so during the time of fixed exchange rate, so every country to fix the exchange rate for every country was very difficult. It was very difficult to fix based on the fixed exchange rate. If it is a floating is nothing but changes, changing for one country it will be changed, for more country will be changed based on certain circumstances. At that time it could be a better the flexible exchange rate. So because of that, so many the central banks as well as the international institutions they said the flexible exchange regimen is good. So now what exactly happens or what is the current exchange rate regimes? So current exchange rate regime is nothing but an exchange rate in the price of one currency in terms of another currency. That is nothing but current exchange rate regimen. The purpose of the exchange rate system is to facilitate and promote the international trade and finance. So, as I said, the current exchange rate regime is nothing but the main aim of having the exchange rate is nothing but we need to borrow from other countries and other countries should borrow from our country. To promote the international trade and buying up selling of goods from other countries, data has started. There have been three major exchange rate regimens from the historical perspective. One is fixed exchange rate, floating exchange rate, and one more was floating and flexible. One more was the managed exchange rate. So fixed exchange rate is nothing but which is fixed for every country. The fixed is followed. Floating or flexible is nothing but so based on the different countries they have to follow the volatile or the floating exchange rate. Floating is not a changing exchange rate. Then the managed exchange rate. So managed exchange rate is nothing but it's a hybrid of the fixed exchange rate as well as floating exchange rates. So this is how the current exchange rate regimen was followed. And so in the international market or the international environment. So next we have the economic and monetary union. So economic and monetary union is nothing but it represents a major step in integration of European Union economics. It was launched in 1992 and it was coordinated with the various economic and fiscal policies. So the practical thing, the economic and European Union is nothing but it is a coordination of economic policy policy making between the member countries. So in the European Union or the Economic Monetary Union, it was majorly for the European countries, and the many members of the states were the policy making and coordinating of fiscal policies, notable through limits of government debts and the deficit. And this union was built, the mainly EMU union was built to have the single currency, so that the fluctuation was reduced, and they made euro as the single currency in the European countries. And an independent monetary policy was run by European Central Bank, so it accepts the euro as a single currency, and they used to do all the transaction as per the euro denomination. Single rules and supervision of financial institution within the euro area. As I said, the euro was the currency where they can make all the rules and regulations or the supervision by the financial institution as per euro only. And the main aim of the economic and monetary union was to have a single currency and the euro area.
So next is foreign investment. So foreign investment is nothing but, so when the foreign countries, for example USA or Russia or UK or Japan, some other country is investing their amount on our country, it is called as foreign investment. Or as a India, I am the investor of India, if I invest in US or some other country, it is called as foreign investment. It might be in the as in purchasing a stock or building a company, or anything may happen. For example, if an American company invest in an Indian company, it will be a foreign investment. You can see here in the example also, American company invest its capital on Indian company. The investment is might be in the manufacturing unit, or if they're investing in capital or purchasing the land and building, or all the factors of production, they can own it. It is called as foreign investment. Next, types of foreign investment. So foreign investment is divided into two. One is direct investment and one more is portfolio investment. So direct investment, it has a wholly owned subsidiary or joint venture or acquisition. So the foreign direct investment we'll study in the next slide. And we have portfolio investment, that is investment by foreign institutional investments or investment in ADR, GDR as well as FCBS, FCBC, etc. Next, we have the following of the sectors are prohibited for foreign investment. So these are the following sectors where the foreign investment is prohibited. Any other country cannot invest on these businesses, especially lottery business or gambling or nidhi company or atomic energy or the railway operations. Next, foreign direct investment. So, foreign direct investment is nothing but it is an investment made by a company or an individual who is an entity in one country, where they're going to take the control of ownership in business interest in another country. So, that is nothing but when the other countries they purchase the factors of production. So, factors of production is nothing but land, labor, capital, organization. So foreign direct investment is nothing but when we are investing on other countries, or other foreign countries are investing us or taking the control of the factors of production, that is called as foreign direct investments. There are various types of foreign direct investment. One is horizontal foreign direct investment. So as you know, foreign direct investment is nothing but if you are investing on in US, or US is investing on us, it is called as foreign direct investments. They're going to take the control of the factors of production, or they're going to start a new company or build a new company. So types of foreign direct investment. First is horizontal foreign direct investment. So the company invests in the same type of business operation in the foreign countries. Take for example, an US based car manufacturers open a car manufacturing plant in India. So horizontal is nothing but the we are investing on the same business operations. Here no other changes will happen. The same sector, we are investing on the same sector. The company invests in the same type of business operation in the foreign country as it operates in the home country. For example, the US based car manufacturer opens a car manufacturing plant in India. Both are manufacturing units. Next, we have vertical foreign direct investment. So, the company invests in a foreign company that is a part of its supply chain. That means upstream or the downstream. I will give an example, you will understand. A clothing brand investing in a fabric manufacturing in another country. Both are related to the same supply chain but not the same business. Here, clothing company brand investing in a fabric manufacturer in other country. So both the function is same but they belong to the same supply chain but not the core thing. Next we have conglomerate supply chain. So conglomerate supply chain. So investing in a business that is unrelated to the investor existing business operations. So conglomerate is nothing but here investing on the business that is not related to each other. For example, the US based tech company investing in a food production company in Brazil or India. So US technical company is different or tech company is different, food production is different. Both are not related to each other. Here, tech company is investing on food company in some other country. Here, both function are different. So that is nothing but conglomerate foreign direct investment. So next we have the greenfield investment. So greenfield investment is nothing but it's a type of foreign direct investment where the parent company builds its operation in a foreign company or foreign country from the ground up. From the ground is nothing but from the scratch they're going to build a new factory or office. That is from the scratch itself. Now there is no existence of any building or any company. Now from the scratch if you are going to build a new company then it is called as greenfield investments or greenfield foreign direct investment. Next we have brownfield. So the greenfield is nothing but you are going to start from the scratch. Brownfield is nothing but if you are going to buy a old factory or repurposing its new production. So that is brownfield. The last one is platform investment is nothing but the foreign firm invest in country to serve as an export platform to other countries. Take for example, an US firm builds a factory in Mexico to export to that other countries. So that is nothing but you're exporting to some other goods, they will export to some other country. That is nothing but platform investment. So next we have foreign portfolio investment. It is nothing but holding financial asset from a country outside the investor's own. It might be regarding the stocks, ADRs, GDRs, bonds, or exchange traded funds. So portfolio investment is nothing but if you are investing on other take for example if you are investing in the US market shares ADR, GDR, then it is called as foreign portfolio investment. So here we have so international equity. International equity is nothing but the same equity is nothing but the share. International equity, the shares of the company that are listed on stock exchanges outside the home country. So international equity is nothing but suppose US is having one stock exchange that is New York Stock Exchange. If I am the person of India, if I am investing on New York Stock Exchange, that is outside the country, it is called as international equity. International bond is also same. If you're purchasing any debt securities outside the country, then we have ADR. So ADR is nothing but American Depository Receipts. So we'll give an example. You will understand. Take for example, I have a company called ABC company, or take for example, Infosys company is there in India. Suppose Infosys company want to raise amount from US or from the America directly. You can't raise the money. That is one point. So how you can raise if Infosys is listed in the America, that is New York Stock Exchange. If it is listed there, from there after listing in New York Stock Exchange, it will allow US investors to invest in Infosys of New York Stock Exchange. There they will raise of money. Once the American investors raise the money in New York Stock Exchange, New York Stock Exchange will provide ADRs. So after issuing their money, they will provide America depository receipts to US investors. Done. So that is how the Indian Infosys will get the fund. For raising money, they will provide, the New York Stock Exchange will provide ADRs to the US people or US investors. So that is nothing but the India list ADR on New York Stock Exchange. They are going to allow American investors to buy Infosys shares in dollar. So in the same way, global depository receipts are nothing but they are similar to ADR but used to trade the shares in international market outside the US. So out, if you want to trade outside the US, if you're trading in US, it is American depository receipts. If you're trading outside the US, take for example, if you're trading from Japan, you want to raise money from Japan, and directly you can't raise the money, you need to go for Japan. There the stock exchange will be there. There the company has to be listed. Then after listing, they will try to, Japanese investors will invest on the Infosys. Then the fund money will be raised. For that they will give the GDRs. That's how the things will happen. For a global depository receipts, typically we call it as the Europe. Next, zero coupon bonds. So zero coupon bonds are nothing but they don't have any periodic interest. Instead, they are issued at a deep discount on their face value, and the maturity and the mature at their face value. Here, zero coupon bonds is nothing but zero coupon is nothing but no interest rate, no periodic payment of interest. Next, we have euro bond. So Eurobond is nothing but fixed income debt instrument that is denominated in different currencies than the local one, where the bond has been issued. Hence, it is the unique type of bond that is nothing but Eurobond. So next we have floating rate notes. Floating rate is nothing but they are the fixed income bearing securities that pay a coupon. Coupon is nothing but interest determined by the reference rate. So for periodically, for monthly wise, they will fix some interest and on the securities, and they will get the income. So that is floating rate notes. Next we have foreign institutional investment. We call it as FII. It is nothing but it's investment by the foreign entities in securities, in real property, and other investment assets. This includes your mutual fund companies and the hedge fund companies. So when you're dealing with some other countries, there is a huge risk. So for that, they are going to diversify the entire investment. It might be on including mutual fund as well as hedge fund. The intention is not to take controlling the interest, but to diversify the portfolio is nothing but if you're having diversification in a portfolio, if you're investing on different aspects, then obviously the risk will be reduced. Next we have international money markets. So international money market is nothing but it's the short term borrowing, lending, buying and selling with the original maturities of 1 year. As you know, the money market that deals with the short term instruments. The same way, there are various the money market instruments if you want to deal in an international market. So the international money market instruments are the euro currency deposits. That's a timely deposit the outside the India. So all these international money market instruments which are not in the Indian perspective, it is in the international perspective. Euro currency deposit is nothing but if you want that the timely deposit which are available outside the home country such as euro dollars or euro yen. Then certificate of deposit. So likewise, if you're dealing in a Indian, then the money market instruments or certificates of deposit and bill of exchange, all this will come inside the country. So here we are dealing outside the country. Certificate of deposit or another negotiable instrument issued by banks, typically with the maturity ranging from few weeks to a year. Then commercial paper, which has a maturity up to 270 days, and it is unpromissory, unsecured and promissory notes. Treasury bills, the short term the government securities issued at a discount of their face value. They are issued less than the face value and they are matured at a par means same value. The repurchase agreement, or we call it as repos agreement, involving the sale of securities with an agreement to repurchase them later in a later date, usually a higher price. The same is purchased again with a higher price. Then bankers' acceptance, time drafts accepted by the banks guaranteeing payment. Usually during the time of international trade, you use the time drafts for doing the transaction. Next we have forward rate agreements. So in this agreement, it is a kind of the financial contract between two parties to lock an interest rate for the future period. That is nothing but, so today they are going to fix what should be the interest on the future. It's a contract between two parties where the two party will agree to fix a interest rate today for the future transaction. And there is no the physical money that is borrowed or lent. It is to the notional amount where they want to fix the amount and they're going to charge the interest rate today the for the future transaction. And as I said, it is the over the counter because there is no physical existence, everything happens through online. And uh, and the settlement is paid in cash based on the difference amount on agreed and market rate. So whatever they agreed, whatever the market rate is there, and they will pay the cash. So thank you. This is chapter number 1. From chapter number 2 we'll start with the foreign exchange market. Thank you.